Position and money management. If you're taking this course as a standalone, congratulations on your first step. As we go through the course, I will explain other concepts from Master Trader Technical Strategies, just to reinforce some of the concepts of support, resistance, and trends, and so on, to get you somewhat up to speed. Of course, it's recommended to take the whole course, and once you've gone through this part of it, I believe that you will be ready to move on and gather all of the information together. If you're an old student from the past, you may be aware of the other concepts spoken about here, and that's great. This will help you, and I will try to reinforce more of that as we go along. What we're covering here is applicable to any tradable instrument. It doesn't matter if you're a stock trader, a forex trader, whether you're trading equity E-minis or currency E-minis for that matter, or whatever type of style that you are. Money management and position management has to be applied to whatever the instrument is that you're trading. The only difference is really the time frame that you're going to be looking at. So if you're a core trader using weekly and daily charts, you would apply the same concepts to those time frames. If you're a scalper and you're using 2-minute charts with for example, a 15-minute chart as your longer time frame bias, well, you would apply that to the management of the time frames that you're using. It's all the same. All the technical concepts are the same. Trends, support, resistance, retracements, and so on. And the money management, as I said, is the same. Of course, your position sizing will change based on the time frames that you're using and your strategy. Now, when you talk about money management, you can know all the technical strategies that there are like the back of your hand and recite them blindfolded. It really, without having the right money management rules and the position management rules, your odds of success are pretty small. And that's, the truth. Realize a 50% loss of your account requires 100% gain to break even. And you're starting with a smaller amount, and you have to double it just to get to where you are. So that really reinforces the necessity for rules and calculated risk, because it's a major part of being successful. And with the concepts that we're going to be covering here, if done properly, meaning following the rules, your gains can be exponentially increased with the same setups. Now, you have to approach this as a business. We say it's not a hobby, it's not for your entertainment, and I know some do that, especially the types that maybe they're successful in a prior business. They like to watch CNBC. They have some core positions, and of course they want to make money, but it does give them some thrills, or they're involved in the markets. This is not our focus. We are treating this as a business. We are looking to increase our income as income traders. We, as wealth traders, of course, we're looking to increase our wealth, and we have rules for this course is about money management and position management that revolve around all of the technical strategies that we use. Getting into a position, there are things that need to be known. How much room is available for the expected move? What is your target? Finding a setup, some type of a buy setup, which could be as simple as a breakout strategy. Is there room for it to move higher? Is the next reference point of resistance close at hand, which would suggest some type of a choppy, erratic type of movement, or it could be a breakout failure. And this is where the concept of the trading void comes in. And if you're taking this as a standalone course and you're not aware of what a void is, the definition is a gap which leaves a void, is a gap between the prior day and the current day. It's a rapid price movement in one direction where there's no support or resistance left behind, and then through a period of time going sideways that increases the size of the void. In other words, a bullish pattern, a head and shoulders type of a bottom, or a W bottom. So that bottom was preceded by a rapid move to the downside, or a long-term trending move to the downside, and those usually end by an accelerated move and then a period of chopping sideways and prices probing the bottom and coming back up again. And, that is what creates a void above, and the head and shoulders top is a bearish distribution pattern that creates a void below. Next, where does the stop have to be? We have to know where our stop loss is. As compelling as the pattern may be in the moment, we still have to define where our stop is going to be, where we admit we were wrong. It's not working out. And for whatever reason that might be, this is how we define a calculated loss. Have you looked at multiple time frames? That is a major key to successful trades. If you are a swing trader and there's a buy setup, however you're defining that, and we'll look at some examples of that, a buy setup could set up opposite a sell setup within a higher time frame. So the higher time frame could be in a downtrend and has just retraced up to an area of resistance and has started its way down, and during that period of moving lower on the daily time frame, it's very possible that it could have a pullback, which is beginning to turn back up again. So you need to look at multiple time frames to make sure that they're in alignment with your focus, whether that's a swing trader, whether that's a day trader, whatever your goal is. Using those time frames, you have to use multiple time frames. Market conditions. The broader markets will affect the majority of stocks. There are stocks, as we use the term, on your own page, be moving on their own. At times, gold stocks can move on their own. However, intermarket analysis, the direction of the dollar can affect gold. It can affect oil. If you're looking at a stock, you can look at what sector it's in and look at that sector ETF. So there are other things that can affect the direction of prices to be aware of. And I'm just going through this as a information for you to consider, which is not the focus of this course, but it is something to keep in mind. Does it meet your reward to risk parameters? Is there liquidity there? What is the spread between the bid and the ask? Is there volatility? Or an excessive amount of volatility? These are other considerations. You may get recommendations through a service like Master Trader's Advisory Service. You may be in a chat room where a moderator is calling to buy a particular stock. Does it make sense to you? You can't just follow. And even those with a good track record, you still have to be your own trader, meaning does it meet your trading plan? For day traders, what time it is? In the morning, there are reversal periods, 10 o'clock, 10:30, later in the day at 2:30 when traders are coming back from lunch, later in the day at 3:30. Positions are being initiated and or closed, so you need to be aware of that. Is it a quality pattern? As it always should be. Do you have a definition of what a quality pattern is? If you don't, you should. Now, when we talk about risk, how are you defining your risk? Many traders that come to the markets, especially years ago, everything was, I'll just buy $1,000. When, back in the day when there were what was coined at the time SOS bandits, when spreads were wider and there was what's called a small order execution system, novices made money. They bought 1,000 shares and prices would move up 50 cents because things moved in fractions at the time, and it wasn't uncommon for prices to have 25-cent spreads and move 50 cents rather quickly. Back at those times where the markets were less sophisticated in a sense and the technology wasn't, it was relatively easier to make money almost by mistake. And there was that 1,000 shares, whatever it was. That's certainly not a professional way to approach it. Are you going to risk $1,000 per trade? Well, that could be a good starting point. Can you afford to risk $1,000 per trade? It's a consideration. Will you risk 0.5% of your account per trade? Maybe that makes sense. Will you risk 0.25% per trade and 1% of your account? Now we're getting a little bit more sophisticated, and at least in the thought process of what the risk will be. Now you're risking that based on per day and based on master trader strategies. Now you're formulating a plan. Why define your risk, or what we would call R for short in this course? It means consistent losses. and not from the point of view of, just loss after loss. Of course, that is definitely not what I'm talking about. Whatever the losses are going to be, they are consistent and calculated and based on what that risk is per day, per trade, and so on. You're approaching each trade with a mindset of, well, this trade isn't going to wipe me out. And this is where, traders get on what I would call a white knuckle ride. Well, what is a white knuckle ride? Get in your car, put the accelerator to the floor, and, once you're over 100 miles or so, you're grabbing that steering wheel and your knuckles are turning white. We're a state of fear of your life. And there are traders that are in fear, in a sense, of their life when they're trading, because they have no plan, especially for money management, and they are flirting with a disastrous situation. So, of course, they are operating in fear. So defining your risk, you've eliminated that. You're planning, and you can determine the amount of risk per trade, per day, or a week. And so psychology is a major part of money management. All trades are equal, and there's no stress. And if there is stress, and I will mention that I have worked with individuals that certainly could afford to lose per trade what their plan says. However, because of past time of having no plan, they've experienced large losses. They've taken that into the future, and they need to push things down to a risk amount that is meaningless. And at that point, commissions don't matter. It's all part of your long-term plan of being a professional, successful trader. So wherever you have to go to reach your comfort level, just do it. So a little more about defining that risk or R. New traders should spend at least a couple of weeks paper trading and then go to small share risk amount. I say you want to think long term. You say the market's not going anywhere, and your money might. There are lots of traders that never made it only because they didn't have a money management plan, and they lost too much money. They certainly could have been successful, but they incurred losses to a point where they felt that they had to stop. Probably was the right thing. They would have lost all of their money. However, if they had a plan, and within that plan, I've taken a class. I know I have to become familiar with the strategies. I also have to become familiar with experiencing different types of market environments. I have to become familiar with my trading platform. It's very possible you might press the wrong button. Everybody does it at some point. So through doing that, your plan might be that to become familiar with these things, it might take you 6 months, and you may calculate that you're going to be doing X amount of trades per day if you're a day trader, or X amount of trades per week. And if I'm willing to risk X amount of money per day, per week, and so on, by calculating that out, I know that you are going to risk, let's say, $10,000 over the course of 6 months, or whatever the number is for you. With those sets of parameters, well, you know that at the end of 6 months, unless there's some disaster, and part of those disasters can be avoidable, like by not trading biotech stocks and holding them overnight, you know that the worst case scenario is that you're going to lose X amount of money over 6 months. That's going to be your estimated learning curve after getting that down. And after 6 months, if you've done that, you're going to have learned a lot. And if you're not making some consistent profits by then, well, you have to revisit your class and questioning the things that you're doing. Of course, you need to be keeping a trading journal so that you have some information there to see what you're doing right and what you're doing wrong. And by keeping that journal, you will certainly see that, no doubt whatsoever. Look at your losing trades and your winning trades. You will see what is consistent between them. Talk about this in a prior section of the class, where you track all of this in a platform called Microsoft OneNote. It's a great program, and it's probably on your computer already. So the size of your account. Experienced traders may use a percentage of their account size. So by progressing, by working your way up to the next level through successful trading, you can then increase that. Your time frames and strategies. Larger time frames may dictate a higher risk value, and that would be because you're doing fewer trades. As a swing trader, maybe you're only doing 2 trades a week as an estimate of what you might be doing. And through that, whatever your risk is per week, you can divide that by 2 trades, and you could put on a larger position size, of course, based on where your stop is going to be, which is going to be a bit larger for swing trades the majority of times. But we'll get into all of that. And through your trade analysis, keeping your trading journal, you'll find that certain strategies have higher odds of success. And keeping track of your trades and seeing how they're working, different strategies and management. So your risk, that's money. What is that going to be? How much are you going to risk on an individual trade? And that applies to your own situation, whether that's, like it says, $10, $50, $300, $1,000, and so on. We'll get further into this and look at that and how it's calculated. And this next slide these are the calculations that we're going to be doing. These are simple calculations. What is your stop loss? What's your entry price minus your stop price? What is your potential gain? Your entry price minus the target. What is your max dollar loss? The shares times your stop loss. Your share sizing. What is your dollar risk? Divide that by your stop loss amount. What's your maximum dollar gain? How many shares do you have? How far will it move? What's the potential gain? This is all very simple, but I thought it would be good to just give you the calculations here because we're going to be doing a lot of that. Your reward to risk. Your dollar gain divided by your dollar risk. And your target gain, simply your entry minus your targeted shares times your shares. So here is an example of how you could decide your risk based on your account size. And we're saying here's a $100,000 account. We're going to risk 1.2% of capital on any given day. And we're going to take a max loss per trade of $300, which will allow us 4 trades per day. If you have 4 losing trades, well, you're done for the day. No more trading. Turn it off. And it's not like you have to turn off the computer, but you certainly have to turn off your ability to place live trades. Of course, you can go into paper trading mode. And if you do that, you need to approach that paper trading as if it's real trading. Don't press the button unless it's something that you would really do it. And the other side, if things are going well as you're paper trading, is it because of the lack of emotion connected to it? That's something that needs to be considered. And you shouldn't feel bad that you turned off the live trading, because that is just part of your rules, and this is part of the discipline of following the rules. So here, you can see one of our calculations in this simple, where your stops are and your maximum share size, where I've got a $300 risk, and if my stop is 40 cents, I can trade 750 shares. That would be my share size to execute the trade. We're going to determine risk based on the chart. There are methods which would say that, well, I'm only going to risk X amount of dollars per trade, and at least that's a starting point. But some of these methods do not take into consideration the technicals, which for me, I approach the market, it's kind of like just a shot in the dark, whether you'll get lucky or not. They may say, well, prices have pulled back. Maybe they're a Fibonacci type of trader, and it's pulled back 50% from the prior move. So I'm just going to enter there and with a predefined money stop and see what happens. That can work, but that's not our approach. We're going to have predefined setups based on our technical concepts. And that's how we're going to enter and where we're going to put our stop. I'm using $300 risk. Now, at what point are you going to put your stop? Where is that going to be? On this slide here, I'm showing different levels of where your stop would be and the size of that stop. And you can see as it gets further away, we're reducing the amount of shares. Now you may look at this and say, well, Greg, this looks great. I can get 2,000 shares, and if it goes to my target, I'm going to make X amount of dollars more than if I take the 30-cent stop with 1,000 shares. I would say, well, that's absolutely true. It's black and white. That's the math. Of course, that's assuming the setup works out as planned. Sometimes, for whatever reason, you may decide that this setup looks good, But there are certain things, if you will, that have created a bit of uncertainty about this actually working out with a tight stop. I like the pattern. I like the trend, different concepts that are all coming together. They all make sense to me, and I'm going to place that trade. However, as I said, for whatever the reason might be, I feel I'm going to give this a bit more room. And to do that is all well and good, and we're going to look at this in different ways of how to utilize that and take advantage of it. And then if I give it that amount of room, of course, if it goes down there, I'm still losing the same amount of money. It's the same $300 risk regardless of where the stop is. It's less shares, of course, but I'm still risking the same $300 at each point. Target considerations. A larger target requires a less restrictive management to achieve that. As it says, you can't hit a $3 target with a 10-cent trailing stop on a 1-minute chart. That is ridiculous. It's just not going to happen unless you get extremely lucky, and we're not looking to get lucky. We're looking to be consistent in what we're doing. You can't hit these big targets without living through some retracements. It is what it is. If you're holding a swing, or actually probably a core type of position, and prices are even accelerating to the upside, and you've got a good profit, and that type of a move strongly suggests that prices are going to pull back, yet you don't want to give up the shares because you believe it's going to go even higher, but the evidence is such that it's very likely to pull back. So selling covered calls at that time. You're going to sell a call option above recent prices because you believe that prices are not going to go there. And as the stock declines from that point, as the price suggests, those call options will lose value or possibly even become worthless, which reduces your cost. You get to keep that money for that option that you sold. It's a great strategy. It lowers your cost. And many that hold long-term positions in a stock that does continue to go up over the long term can continue to generate income by selling those covered calls. Intended duration in the time frame. Well, the management starts in the time frame that you're trading in. You cannot hit a swing target trailing bar by bar, and I'll explain what bar by bar is, but you can't hit that target on a 5-minute time frame. Can't tell you that I avoided that mistake in the early days, because I was trying to tighten the stop up. I was trying to, of course, keep the gain that I had and then move to a small intraday time frame to manage it, and would get stopped out only to see the stock move in the direction suggested by the higher time frame. Doing a swing trade, if you're going to move to smaller time frames at a certain time, use the hourly time frame. As you condense that data, you are by definition seeing fewer corrections, and that's exactly the goal, what you want, not to be influenced by minor movements against the bigger time frame. Personality traits. It says some traders can't give back a dime. They're just nervous traders. So you have to know who you are as a trader. And there are certain things that may not be avoidable, meaning that's just who you are. And accept that. You're going to manage in a tight way. Hopefully you have a high batting average, meaning you're right a lot more times than you're wrong, because your winners are not large, but you're trading consistently with the method and plan that you were using, so you make money. It's okay. I've worked with traders that admittedly are nervous traders, and they make very good money because their plan revolves around how they are. Some traders do not know why you would ever sell anything. I'm not one of those, but they want to hold on, and I know people that have held Johnson & Johnson for many years and have made a very large amount of money by doing that, but they've sat through some horrendous corrections as well. So this considerations must be given to the work with the personality at hand. So trade intention and the time frame reality. Smaller time frame, the more data, the more pivots, the more shakeouts, etc. So as explained, you can't go down to those smaller time frames because those things, pivots, shakeouts, and such, they're going to happen on those smaller time frames, but they're not meaningful. in a higher time frame. So there's some guidelines. As a core trader, you manage from the weekly charts and zoom to the daily. As a swing trader, you manage from the daily and you go to the hourly. Most of the day, manage on the 15-minute, and you can go down to the 5. A morning trader, gap trader, holding into lunch, 5-minute charts, stay on the 5-minute chart. And if you're a scalper, you can manage from the 2-minute. You may go down to the 1-minute. I don't suggest going to the 1-minute because unless there is strong momentum moving in one direction, the 1-minute will certainly stop you out. All right, let's move on to part 2. Position and money management, part 2. Well, in part 1, we talked about your professional approach to investing and trading. It was based on how to measure risk. Is that going to be $1,000 or 1,000 shares? We talked about calculated losses, not gambling. This is a major key to your success. We also talked about aligning your trading time frame and risk management. How much are you going to risk per trade, per day, or per week? Where are you going to place your stop, and why? We use charts to assess that, our entry, our target, and our stop. We cannot make it to a large target in trading from a small time frame. It just doesn't work. You have to decide, is day trading for you? It doesn't have to be. However, if you wanted to trade from a higher time frame, say a 30-minute chart or a 60-minute chart for intraday trades, entries, and exits, that's fine as well. Is your personality made for day trading? It may be, it may be not. There are traders that, just as I've talked about, were just nervous traders and they couldn't do anything else but day trade. Could never hold overnight, and that's fine, as long as they have a plan for doing it. And it's a profession. You have to treat it like one. And as we go through the course, you're going to see how exactly you're going to be able to do that, managing positions in the proper way and proper money management. We need help. We need rules. Once you're in a profitable position, to attain that larger gain, we're going to have to let it correct. There's no way around that, and there's no way to know the extent of the correction. And it does require giving back part of the gains to acquire that larger correction. Like I said, there's no way around that point, but if the stock hasn't reached a target area of resistance if you're long, or an area of support if you're short, the odds are with you. Of course, that's going to be based on the proper assessment of the trend and entry point, but you need to do it objectively. Let's figure out how. We need guidelines for raising stops. We'll start with the first point of reference, that being a prior bar's low if you're long, and that being a prior bar's high if you're short. That prior low is an area where there's support initially and resistance at the high. Now, if you're long a position and you're trading within a void, you're going to want to hold on to at least part of that position, even if it violates a prior bar's low. I'll talk about when to use a prior bar's low. Now, unless prices are accelerating, you're just going to sit and let things develop, meaning the price action to unfold. If they are accelerating far away from your entry point, it's okay to sell half below a prior bar's low. It's liable to correct at that point. So once that does happen, let it pull back, and we're going to wait for a pivot to form. I'll explain that. But once that pivot is established, you'll then bring your stop under that pivot low for longs. As the stock moves closer, supply, and I interchange the word supply for resistance because that's where sellers are going to be, the stop is brought under the prior bar's low again, and ideally that's happening as prices begin to accelerate to your target point. Let's talk about the two position management methods. There are pivots and there's bar by bar. A pivot process of managing that position, we need to let it pivot, of course, and establish a reference point of resistance with some price action occurring over a period of time. So we're going to define that as a minimum of 2 higher low bars to the left and right of the pivot bar. So here you see a move down, and then momentum begins to stall, and prices move back up again. So once we have 2 to the left and 2 to the right, we say, well, it's pivoted enough for us to consider raising a stop under that low. Now, once it takes out this high, well, and that has established an even stronger pivot point. The more bars you have to the left and to the right, the stronger the reference point, because the more trading action has gone on, more time has passed by, and that's established a stronger reference point for us. And we're going to continue to monitor these pivots as they form and how the price action unfolds. Now, bar by bar is just what it says. As each bar forms, it provides us a new reference point of support for longs. So when every single bar begins to form and then close, it has created a new reference point, and during periods of acceleration, we could begin to trail bar by bar. Not until that happens would we even consider it, because it would just be too tight and the odds of being stopped out are extremely high. So here's a pivot, and we're going to look at this through multiple time frames as well. So there are times when a 2-bar reversal, we could use that as a reference point to raise or stop. However, we only want to do that once we have a larger reversal. Smaller reversals tend to be meaningless for the most part. So once we have a larger reversal, a larger red bar down and a bit larger green bar up, we know that that is going to be a pivot in a smaller time frame. So we can trail under a 2-bar reversal if it's a larger reversal. Combining the management methods. We're assuming our entry right here on this turn. The price is accelerating, and we define accelerating by multiple bars moving in the same direction, where the opening price is right near the prior closing price. So we got a large move in one direction, multiple bars moving that way, and the separation between the bars is really defined by the time frame that we're using. In other words, if this was a 5-minute chart, our software would be saying stop collecting data, start collecting it on the new bar, so on and so forth. And this would be a large bar in one time frame. Now the point here is that when they begin to accelerate in this way, it's creating what we call a price void. In other words, there's no support underneath it, which the prices could then pull back a relatively significant amount. If this is the beginning of the move, it really shouldn't pull back that far, and typically will pull back into the area of what was resistance and becoming support, and what we call an area of minor support. That being said, in reality, there's really little to nothing underneath here, and the assumption is that this technical concept is going to hold, and that's where the turn would be. So we take partial profits, but then we will let it pivot. So once it pivots and begins to turn up, we can then begin to trail that pivot. So we only do bar by bar if prices accelerate. Otherwise, once it's halfway to target, you can use a pivot once it forms. Now, as it's pushing higher and pushes up above the prior high, what you could do is move to a lower time frame to use pivots as prices begin to accelerate. And I explained in the way to do that, looking at this time frame, looking for a larger bar. We'll look at this in another slide, but as prices transition from a red bar to a green bar, there'll be pivots there. You'll learn to look at this and understand it within multiple time frames. If you're taking the whole course, review the multiple time frame sections again, where I cover that extensively. As it's moving higher, as it gets closer to your target, and ideally, as I explained, begins to accelerate, you then begin to trail bar by bar again. And so once it begins moving higher, you then begin to trail your stop under the prior bar's low. So here's an example of the two time frames and a larger bar reversal right here. And we're talking about the transition from red to green. And this 2-bar reversal, ideally in a higher time frame, is going to be a pivot in a lower time frame. This is how momentum slows down, and it always does. Just depending on the time frame you're looking at, you may not see it. As to turn from this red bar into a green bar, in some time frame, momentum slowed down, and these are examples of how that can happen. It can happen in a multitude of different ways. I'm just showing you two, and how it turns doesn't matter all of that much. And it's to understand as you look at those lower time frames, it has to pivot, it has to turn, the momentum has to slow down, and the smaller the time frame you look at, the more bars you're going to see by definition. Well, there's just two examples of how that might happen. This is for that reason we'll trail under a larger 2-bar reversal. We don't want to use any 2-bar reversal or small reversals because they can be relatively meaningless, just some noise, choppy price action. So those larger reversals tell us that there was an increase in volatility, and once that turn happens, it shouldn't go back underneath it. Because of that turn, it should continue in the direction of the turn. And says ideally this happens during times of increased momentum. And we talk about bases and trailing bar by bar. You don't want to do that right after you get in. It virtually ensures being stopped out. That I can almost guarantee you. So there must be a period of acceleration to create that void. At those times you'll consider selling half. Now trailing after a base, as we all know, the ideal situation on a breakout is that prices don't move back under the bottom of the base or even back into it. However, we need to consider the size of the breakout bar. If it's a small breakout bar, it's of course not the ideal, but it might come back in and wiggle around. If it goes back down under the way I've shown you here with this shakeout, clearly something is wrong. This is how you want to look at bases. The buying breakouts from a base is one that has this type of a shakeout. And I've shown you with a bottoming tail bar. However, it could be a red bar down and a green bar right back up again. The message would be the same. And during a shakeout, you have that move to the downside. Prices come back up to where they were consolidating, and they consolidate again, and then they break out above the range. Now here we've got a wide range bar breaking out of that range, and prices should not go back down below the low of that wide range bar. Many times you're going to get a stall in momentum. It could be an inside bar where prices consolidate. One of the concepts covered in the multiple time frame section is that a wide range bar creates a void, and there's a lot of smaller bars in a smaller time frame. So a consolidation after a wide range bar is relatively normal. The ideal scenario, of course, is when we buy a breakout and wide range bar and then you get another one and prices accelerate higher. Doesn't have to happen that way, but when it does, it's great. Well, the bottom of that bottoming tail bar is going to be a pivot, just like a 2-bar reversal. As I said, whether it's a red bar down and a green bar up or it's a bottoming tail bar, there had to be some slowing in momentum and a turn in a smaller time frame. Now, this isn't to suggest that you'll be buying this. Not in a situation like this. Type of a shakeout is one in which we observe it, we put it in the context of a trend, and then take action at the appropriate time. So our management of a position is based on the understanding of corrections and price action. I mentioned minor support as prices move up, and clear resistance as they pull back to it. That reference point of minor support is often where prices are going to turn up, even though there's nothing of real significance here to the left. This even subjective reference point that's widely known by almost anyone that looks at a chart is where they're looking to buy, and it becomes a self-fulfilling prophecy and exactly what we want to see after a momentum move up above it. Now, the strongest of trends, many times they won't even pull back this far. They'll go sideways, and that's much more bullish. Once prices begin to turn here, ideally they'll take out that high, and once they do that, we now have a reference point, a new reference point, which would be major support. Up above here, this is our major support, this is our minor support, and then we'll look to see how the trend continues. Already talked about the base and the shakeout here, the pivot, and this would be a higher time frame. This could be a lower time frame where we would see that type of a pivot. And I said it's the bottom of a tail or a 2-bar reversal is going to show us that slowing momentum. Prices push up above the old high. we then have a new reference point of major support that we would not want to see violated. And this is how we then monitor the trend on a continuous basis, bar by bar, and then as pivots form, we then trail stop. Let's move on to part number 3. Position and money management, part 3. All or nothing. This is considered the standard in management styles, and where most start once they have some type of a level of understanding of what they're doing. Very basic level, of course. And that starts with a target. We've all been where we buy, and then at that point, most of us at the beginning stages of what we're doing, we just wait to see what's going to happen. Our hopes is that prices are going to move in the direction that we've picked, and most of the time when starting out, that's going to be on the buy side or being long. Eventually, other than a very subjective thought about where prices are going to go, we come with a target of where we believe prices should eventually move to. However, most are never going to wait for that target to be hit. And of course, that's understandable since they have no plan at all. So how are they going to manage it? Most are going to manage through emotions and any reaction to what's ever good or bad or considered good or bad. As you start to look through charts, of course, and you're long, any red bar is considered bad, and it's likely that you'll react to that. And whether that's meaningful or not, how would you know? Unless, of course, you have a plan and a way of interpreting what's going on. So this all or nothing method is probably a lot better than whatever you're using now, that being second guessing what's happening in the moment. As we go through this course, and you do get an understanding of the more advanced management styles, this all or nothing is going to be what you're going to measure that against. Meaning, if you did absolutely nothing at all, would you have done better than whatever you're doing right now? As well as the advanced management styles that I'll be showing you. Before you can use these advanced management styles, you certainly need to be able to understand and implement the Master Trader Advanced Technical Strategies taught in this course. So you need to have a plan for understanding that price movement and how to react to it or the lack thereof. And then from there, you can apply the management styles that we'll be talking about. It's most likely that this is what you might be doing now, or what you are doing now, that many will be wiggled out at one of those stars where there's a minor reaction. In all likelihood, you're probably experiencing what's on this chart right now, where you're being wiggled out at one of these stars. As prices moved up, you saw this larger red candle, and then there was a little bit of a move up. And then this second red candle convinced you that prices were certainly going to be going lower. And they might have. That's the reality of what we do. We just really don't know. So we have to operate on a certain level of not knowing and accepting that and just letting things play out. There's just no way around it. As I said in a previous module, there are going to be times where we're going to give back profits to attain a larger one. So as prices develop, as already explained, through pivots or bar by bar, we can then begin to manage and bring up stops. And as we learn to do that on that very simple level, that's when we can start applying the more advanced strategies that we're going to talk about. But most are going to focus on not losing, keeping a small profit rather than their plan. And that in of itself is what you have to focus on initially, is just having the discipline to follow their plan. Now, before you can do that and maximize gains through the advanced management that we're going to talk about, you have to be able to follow some simple rules. And of course, how are you going to do that? The first thing you have to do is be able to do all or nothing. So here's the all or nothing style, where we see a setup. And this would be the beginnings of the type of setup that you should be looking for, where prices are already trending higher. They're pulling back to an area of support where buyers are likely to step up, and then you some type of reversal or at least a move over a prior bar's high. Once that happens, you're picking your entry point. Our style is always to wait for prices to trade above a prior bar's high for entry. That's our first reference point of resistance. And then we're going to put a stop under the prior bar's low, and then we calculate how many shares once we have a target. So we have an entry point, we have a stop, we have a stop here, which is the distance between our entry and where we would exit the trade based on our plan. And in this case, the way I'm doing it, this would be 15 cents. This bar is 15 cents. And if we're going to risk $300, we then can calculate how many shares that we're willing to buy based on our stop loss and our risk. And in this case, it would be 2,000 shares, since we're going to risk $300 divided by the 15-cent stop loss gives us the 2,000 shares. And if we adhere to the all or nothing style, if this is our entry and this is our target, and whatever happens between here and here, we're not going to pay any attention to and just let it play out, then our gain would be $2,200 on that 2,000 shares times the $1.10 gain from our entry to our target. And then when we figure what is our reward to risk, or what we call how many R's do we make, that would be 7.3 R's. And that's calculated by a $2,200 reward divided by our $300 risk, meaning we made 7.3 times our money, the $2,200 reward, between our entry and our target price. Now, as we look at all that, we have to decide what's the quality of the setup, what's the market conditions, is it a trend trade or is it a counter trend trade? And as these things come together, we begin to formulate, making a decision, which all of this has to be decided beforehand and put into a trading plan as to the type of trade you're going to be taking. In other words, if you are trading against the trend, how are you doing that? The way we do it, of course, is going to be a climactic type of a setup. We can trade it in a smaller time frame, meaning once that setup occurs, we can then look for a trend reversal in a smaller time frame. And all of this is part of understanding multiple time frames and how to manage that accordingly. And of course, we'd be looking for that price void to happen, and that is what a climactic type of pattern defines, is that there's a large price void, and it's likely that prices are going to retrace back down. As we've taken that entry point, hitting our target, we're doing nothing and waiting for that to play out. As we learn how to utilize the advanced management strategies and understanding different market environments, we can then begin to apply those advanced strategies. Most traders confuse high reward to high risk setups with tight stops. And I've worked with lots of traders that focused on very small time frames because of the extremely tight stops. And what was the result of that? The majority of them took a lot of small losses that add up to large losses. Even think that any support area is going to hold to within a penny is not only flawed, it's ridiculous. However, so many traders do it over and over and over again, experience the same results, but because they're trying to, in a sense, hit it out of the park, trying to get that home run type of trade, most of them are trading too large a position size, and of course that's why they're using those small time frames and getting stopped out so often. High frequency trading, that's accentuated this. By watching how many times prices will reverse after going through some area of support, you have to believe, and I certainly do, I've seen it enough times, that these high-frequency trading algorithms, part of what they do is knowing where the stops are, and as prices push through it, and maybe they are the ones helping to push through it, prices will immediately reverse back in the other direction. Most trades that stop out soon after that entry are because of questionable setups. So the first thing that you have to get in order is making sure that the setups that you're trading are quality setups. Most traders, they're going to experience fewer stop outs with larger stops, giving it more room. We've all probably experienced, I know I have in the past, you're stopped out by pennies only to see the stock go to your target. Now the second try will often work. Most traders are going to pass on that because Now, the psychological part of what we do and experiencing that loss and not wanting to have another loss stops you from doing that. Now, what's the answer? Heading says half the shares and twice the stop. In other words, by reducing the share size and giving it more room, you're allowing the stock to move. The focus of doing this is really to allow you to sit back in a comfortable state of mind and let prices move, and for you to begin to experience that and seeing the movements and how things can play out according to your plan without having the emotional effect of the trade being part of your decisions. So here's an example. The same setup, same entry, same stop, but now we're going to be giving it more room. Actually, twice the amount of room that we originally had talked about. And it's not going to be under this bar right here. We're going to give it twice as much room, and the way I'm just showing you that here is it's going to be under this support here. So we're going to be giving this a lot of wiggle room and to hold within this area of support with the same amount of risk. With the larger stop, we're reducing our share size in half, which of course reduces our reward in half and the amount that we're going to make on our risk amount, in this case 3.6R instead of the 7.3 that it was. Now at that point we're just going to let it gyrate, and if it goes up to our target here from there, well, that's all well and good. That is one trade in the box, so to speak, or under your belt to record into your journal as to what happened. You'll capture the chart, you'll take some notes, and you'll begin to track trades like that under this all or nothing method. Now, if prices came down over here and wiggled around, of course, that is part of what you hope is going to happen, because you want to see how that is going to play out on this particular trade. And each trade will act independently of the last. And that is one of the hurdles or things that you have to experience and realize that like-looking setups don't always react in exactly the same way. So we have to be open to how things can develop differently. As a pattern trader, and that's what I like to call what we do, we're price pattern traders. We look at patterns from the past, and our expectation is that it's going to be a similar outcome, not the exact outcome. And that's what most of us want, because that's human nature. We want to know that exactly that this is what's going to happen when we press that button, but it doesn't always happen that way. It's great when it does. So half the shares, twice the stop, allows you to experience what's happening without the emotional attraction that it has to it, and you don't have to react to every little wiggle. Here's an example of how we would interpret what's happening on this particular chart and using it. So the question is, well, why should I take this trade? Well, the trend is up. Let's say the price action is bullish. What's bullish about the price action? Well, this consolidation here, prices traded under the low and immediately came back up again. So that tells me that there's strong demand and there's buyers just hoping that it would dip down. And I know that for a fact because of the reaction after the dip down. And then on the gap up, and this is a pretty normal reaction, gapping out of a base, that traders would sell into it and we'd get a red bar. And especially after it's moved up from the bottom of the base to the top of the base, and then it gapped above it. So once the red bar forms, the normal expectation would be for it to fill the gap. And in any event, a red bar is typically followed through by at least trading under that low. And coming in, it could have filled it halfway, but it didn't fill it at all. It actually gapped up and closed above the opening price, and we call an RBI, a red bar being ignored, is bullish price action. And then prices advanced from there until they gapped up on this day, and then they began to pull back. And they pulled back into support and then reversed. So I know that there's buyers here. So what is the concerns with this? Well, the angle of retracement was pretty steep, and there is an unfilled gap below where this could pull back a little bit further. So we use a larger stop. And here's what happened. And prices initially, they did move up, and then they began to pull back again. Once this did come down and came back up again, it's now created this area of support here that we wouldn't want prices to go below. However, as prices are wiggling around here and then consolidating, we really can't bring the stop up. Right? We have a larger stop in place, and we're going to let this move around. So it says at A, we have the start of a higher low beginning to form. Now, once B formed and it took out this pivot high, I can then bring my stop below here because I have a pivot in place. And after B, if prices came all the way back down here, something is clearly wrong, and I wouldn't want to hold it down into here. And even though that might hold, it's just not what this particular setup should do after this green bar has closed. Now, after it starts moving up and we see a wide range bar and prices took out this prior high, and this is one of our retracement concepts, after a greater than 100% retracement, odds are the momentum is going to stall. It doesn't mean that the trend is over. It just means that historically momentum begins to stall after a greater than 100% retracement. And that is what happened. Small candle bodies tell us that momentum is stalling. And we see that there are tails here, but there isn't any follow through to the downside. So we would just have to sit through this type of price action, and we could sell half bar by bar, trading under that bar's low. We sell half our position and then wait for prices to pivot. And once they pivoted and continued to move higher, if they did, well, then we could raise our stop under that pivot or swing low. You're never going to know exactly how prices are going to evolve, but we have a method to manage them. So we've covered all or nothing. We've covered half the shares and twice the stop. And now we're going to move into other management styles. Say there's a lot of ways that we can manage trades, and I'm going to explain each of them to you. Now we're going to cover how to add shares and reduce our stop. Position and money management part 4. Here's our original all or nothing position. We had a setup that was in an uptrend, had pulled back to support. We get a reversal bar here, and we had an entry point of 25.6 and a stop of 25.45. 15-cent stop loss, which gave us the ability to enter with 2,000 shares with our $300 risk. And if prices did get to our targeted price of $26.70, we'd have a gain of $2,200. Right? $2,000 times $1.10, and that would give us 7.3 times our money. You can see the calculation there on the upper left, 2,200 divided by 300. And as already mentioned, we're always checking the quality of the setup, market conditions. When we say market conditions, was the stock showing relative strength at the time? Ideally, it was. In other words, as prices were pulling back here, possible that the markets had pulled back even further, or another situation, the markets are actually dropping considerably into an area of support. In other words, whatever our stock is doing that we're focused on, it is outperforming the broader markets and or the sector that it's in. All right, so now we're going to see how we can maximize our profits and positions by what we call adding and reducing. And what does that mean? Well, it means that we're going to add shares to an existing position when a new setup forms, and we're going to have the same target. Now, while we're reducing the stop, that's the stop loss amount, it's going to be based on the chart, and it has to be based on a new setup that we would have taken. That says this is a very powerful concept. This gives us the ability to increase the share size, which will significantly increase our dollar gain while reaching the same target. And it says we'll do that without any additional risk. Go over a few rules. Well, as we said, it's going to maximize our winners. Now we're playing with the house's money, meaning we have a profit, but it's really not ours yet since we haven't closed the position. It's theirs for us to take, but at this point we say it's the house's money because we haven't closed the position. The goal, take the maximum amount of shares to the target with the same risk. as mentioned, this has to be a new setup that's in your plan. You would have taken it anyway if you missed the original entry point. In other words, it's just a brand new setup, and it's a setup that we would do. It must be a void, right? Meaning there has to be room for it to run. And of course, it's a quality setup based on master trader technical strategies. Adding much more than halfway to the target, you really shouldn't do it, because at that point, logically, the prices have just moved a little bit too far. But, that's a guideline. When you're adding and reducing, we're going to be looking at different combinations. So this is a general guideline. Some common sense needs to be used here. If there's only a dime left to the target and you're adding and your stop is 15 cents, it just doesn't make sense. So a little common sense. The closer you get to the target, you should not be adding and reducing. Let's look at some examples. So here we have our original setup, and that's right here on the upper left here with our entry, stop, our risk, sizing, so on and so forth. Now at this point, as the trade has developed, we're seeing that prices have moved up above the prior high. There's been some consolidation, and as you can see, as prices actually gapped down here, buyers were sitting here in this area and they pushed prices back up. So that tells me that prices should have the ability to continue to move higher from there. Now I have an unrealized profit of $600 at that point. And this is where everyone is now confronted with, do I take my $600? That's a nice profit. We've risked $300 and we have $600 at this point if we was stopped out. So what are we going to do? Well, we have a choice. We can add to a new trade at this point with an entry of 26.10. We have a stop of 25.90. There's a 20-cent stop. We take that $600 and buy more shares. Well, we can buy another 3,000 shares. And if we reach the target with those 3,000 shares, we'll make another $1,800. 3,000 times 60 cents to target. And that would give us 3 R's, or 3 times our money. $600 made us $1,800. Oh, that we call that's 3R. In this example, we see that prices have reached our target. Here's our original trade, which we went over. Here's the new trade. And we had a total risk still of only $300. The $600 was the house's money. It was not ours until we sell. Total share size was $5,000. Total reward, we made $4,000. So with the original entry point and original target, we would have made $2,200. By taking the shares that we had, that gain, the unrealized gain, we turned that $2,200 into $4,000. So there's our target R's, or reward, 13.33, $4,000 with our original $300 risk. Well, let's look at this a little bit of different ways. As I said, there are going to be many different combinations depending on the setups, the market environment, your personality. How do you want to handle it? What I'm giving you here is just different examples of how you could handle a situation. And in this example, we're looking to maximize our gains even further. So in this case, we're going to add a new setup. And rather than just add the $600 gain, we're going to add our original risk amount. Because on the prior example, we would have locked that $300. So now we are going to put that $300 at risk. We're going to take the house's money and we're going to put that at risk. No real risk to us since it's an unrealized profit. And now I have $900 to buy more shares to add to the position. What's my share size going to be? I've got the same 20-cent stop. I've got $900 to play with. And I'm going to buy 4,500 shares at the 26.10 entry point. And at that point, if I can make it, well, not me, myself, if prices can make it to the target, and it's funny how we kind of look at that as ourselves, if we can make it to the 26.70 target, that's 60 cents, 4,500 shares, we make an extra $2,700. And on this trade, we're making 9 times our money because of our own $300 at risk. So in these examples, we're still only risking our $300. In this example, I'm taking the house's money and buying more shares. With that, totally more shares, and my $300 risk is still here. As if I'm stopped out at this point, I only lose my $300. So here we go. Prices have pushed up to target, $26.70. This is our original trade that we've gone over. This was the new trade that we added with our 4,500 shares. And our max risk was still only $300. Total shares now was $6,500. Total reward to the target, now it's $4,900. And we still only risked $300 of our own money. You see how this add and reduce concept can increase your profits exponentially? So our total R's here was 16.3, we made 16.3 times our money. $300 made us $4,900 by taking the house's money and adding that to our money and buying those additional shares. So our original trade still made us the $2,200 from our entry to the target. Then we took our profit plus our original risks, and so we still would have only risked our $300 if stopped out here, and we bought an additional 4,500 shares, that $900, our $300 risk, our $600 of unrealized profits. We were able to get 4,500 shares, which added that to our 2,000 shares, gave us 6,500. Our total reward here was $4,900 with only our original $300 risk. So we've covered all or nothing, half the shares, twice the stop, how to add and reduce. Next, we're going to look at half the shares and twice the stop. As you're going to see, there are many different combinations of how we can manage these trades based on, as I said, market environment and just your comfort level, your personality. How much do you want to risk or not? Let's go on. Position and money management, part number 5. So add and reduce. We've talked about that, adding shares to existing trade when there's a new setup. As it forms, looking for it to move to target. We're reducing the stop loss amount based on the chart with a new setup. Extremely powerful concept. We increase the share size and increases our gain to the same target without risk. So you've got the A in our concept. Let's look at some variations. So here we're going to use the concept of half the shares and twice the stop. Whipsaws, as we know, they're more common in today's market than they were years ago because of the high-frequency trading. They know where the stops are, and they gun for them. We can say market makers, they did that years ago to push things through, but these algorithms, they know the patterns, and they know when prices push down, and they look for the reversal there. So why not give it a little bit more room? So this was the setup that we had looked at before, same exact setup, but now we're just going to reduce the shares to half of what they were. Same risk amount, less shares, more room. So we've got an area of minor support, which is a little base there, which was resistance. It stalled and pushed up above. And once prices push up above that area, the swing low below it becomes our major support point. So we've got support here, and in the ideal situation, meaning a strong trend when there's strong demand, buyers step up at minor support, and then prices push higher. Now, on a side note, we're looking at patterns here where there is a pullback. In a prior section, I did mention about bases and what to look for at that time. And we could, trading breakouts is certainly a viable entry point as well. And just to review, a little bit of review here as to with the base, what we were looking for. Obviously, a base by definition means it's gone sideways. But the ideal type of a base has a shakeout in it, and that could be a down bar followed by an up bar, or it might have a bottoming tail bar in there. In other words, prices dip down and we have evidence that buyers stepped up and there was strong demand and they pushed it back up. In that type of situation, there's greater likelihood that we won't get some type of a whipsaw type of a move where the breakout comes right back in again because there's already been a whipsaw there. Looking for bases, that is the ideal situation. Now, while it's not exactly the same thing here, we have a little bit of a breakdown failure or a minor whip, as we could look at it here, where there was this dip down under these two lows and it came back up again. Whereas with this type of a pattern, we've got a more of a fluid movement down and a beginning of stabilization and then a turn. For whatever reason that we may want to give this more room and less shares, as covered, could be market environment. We looked at one pattern where the retracement was rather steep on the move down, meaning it went up and it came down rather steep into support. But the pattern that preceded all of that was bullish, and so was the trend. So that was a setup that we were interested in. So here, let's do half of the shares and have twice the stop. We look then for a new setup to develop after being profitable. Now, we're always looking to take the profit that we have and add it to the position. So here is the new setup. And in this situation, the way this actually happened, and this is a real chart. This is not an example where I have made the candles. This was actually what happened on this particular stock. I don't remember what it was, but it actually triggered above the high here, and then it came back into support. And this is where the buyers are going to be, somewhere in this area. And this is an excellent reason to do the half shares and twice the stop. This does happen a lot more than it used to. So here's our first setup as we reviewed: entry, stop, risk, share size, target gain. If we hit the target with those shares, and it's 3.6 R, or risk to reward. So as it dipped down, and here we're in what I like to call intelligent hope mode, meaning I intelligently calculated my risk and gave it extra room. I'm hoping I don't get hit on my stop, and prices will turn where buyers should show up. And they actually did. And as it pushed up here through that high, just marginally through the high, we had the gap down and the bullish reversal deeply into this red candle here. So based on that, we have a new setup with a new stop at 25.9, 20-cent stop, and we're going to risk the $300. And here's the setup. Right? New trade. And we've got $300 to risk, and now we're going to add that to our prior trade. Now we're going to say we have $600 to risk. 300 of the house's money, 300 of our money, 300 of the house's money, so $600 to buy an additional 3,000 shares. Target gain $1,800, right? 3,000 times 60 cents. And our R's here would be 6 R's, or we're making 6 times our $300. So we're going to use our unrealized gains to add and reduce as explained. So we're only risking our original $300 if we're stopped out. And there's the move up to the 2670 area, $300 risk, or $300 that we used of the house's money, $600. Our max risk was 300. Total share size was 4,000, our original 1,000. We added 3,000. Our total dollar reward was $2,900, and our total reward to risk, or R's, was 9.6. We made $2,900 on our $300 risk of our money. We've covered all of nothing, half the shares, twice the stop, add and reduce, half the shares, twice the stop, and then to add and reduce. And next, we're going to look at other ways of using half the shares to break even, to lock in a profit, add and reduce with full size, lock in half the profit. Right? There's a lot of ways, and we're not done after we go through these. Let's move on. Number 6, position and money management, part 6. I'm sure you're really getting your head around this add and reduce concept and how to use it. So let's look at it in a few other different ways. And in the last section, we're really going to get an eye-opening as how we're going to use that. So let's look forward to that. So we're going to look at how to do this to break even, how to lock in a profit, and even how to start with a full position size and lock in half of our profit. So that's what we're going to do. Break even, lock it in, or half. Word on protective stops. Have to reinforce this. That's just the definition, as I've put it here. The point at which you have predetermined the probability of the trade working as originally intended no longer exists. So you exit. It's that simple. We can put the odds in our favor, or can be overwhelmingly in our favor. And with the money management techniques that we're talking about, we can exponentially increase the gains that could have been probable with a very basic money management technique. But there's no guarantees. So when the stop gets hit, we have a calculated risk and we exit. Remember, there are choices based on your knowledge, your personality, your experience. So reducing position size is always a great choice when in doubt. We use technical stops, as I showed you, based on the chart. Well, we start with a dollar amount, meaning this is what I'm going to risk. We then connect it to the chart based on the price pattern. This is all based on trend, support, resistance, supply, and demand. This is how the markets operate and how institutions trade. Sure, they'll use things subjective like a 50-period moving average or a 200-period moving average. And when those subjective reference points come into alignment, especially on the market indices and widely known stocks, when they come into alignment with actual real price support, the odds of prices holding there are overwhelmingly in our favor. Now, while we're looking at these charts here and I'm not defining a time frame, you can take this same information and use it with multiple time frames, meaning an example of that would be prices are coming down to a 50-period moving average on the daily chart, and you get a reversal, and then you wait for your intraday time frame, whatever that might be, according to your plan. It could be a 15-minute chart, it could be a 5-minute chart. You wait for the trend to develop. You make sure that there's a tradable void. You then put on your position for the setup as it occurs in your time frame. You have your calculated risk, and you wait for things to develop. And when you get a new setup, just like explained, you add and reduce. You take your profit that you have in there and you add more shares with your risk. You bring up your stop and then continue to manage it according to the plan. Let's go on. So half the shares, twice the stop, add and reduce to break even. And here's our original trade that we've had. Now 1,000 shares, right? Half the shares, twice the stop. And at our new entry point, we have $300 risk. So we're going to take that $300 and we are going to buy additional shares based on the new setup. Now, if we're stopped out and we lose the $300 gain, we're stopped on everything and we're stopped at break even. So the new trade allows us to buy 1,500 shares, and the potential gain, if we hit our target, is $900. And our $1,500 shares times 60 cents, and our reward to risk is 30. We're going to make 3 times our money. 3 times 300, we're going to make $900 on that second trade. So our total risk here is $300. Total share size, 2,500. The 1,000 from the first trade, the 1,500 on the addition trade. Our total reward, $2,000. And our total reward to risk, 6.66. 300 risk, made $200. We still only risked our original $300. You see how powerful this concept is? Half the shares, twice the stop, add and reduce, and we're going to lock a profit. Same original trade, same 1,000 shares, our $1,100 gain if we hit our target with the 1,000 shares, 3.6 R. At this time, we're going to only risk $150 of our profit. We're going to be locking in that $300 of our original risk, meaning if it hits our stop, we'll be losing that $300, and we'll be giving up $150 of our gain. And we will be locking in that $150. And here's the second trade. So $450, 20 cents to the stop. We can add 2,250 shares. And if we hit our target on that, $1,350, and our reward to risk, or R's, would be 4.5, and $300 risk, $1,350 gain on the second trade. Total max risk, $300. Total shares, 3,250. 1,000 here, 2,250 there for 3,250 shares. Total reward, $2,450 and 8.1 R. $2,450 gain on $300 risk. Let's consider we went in with a full size. Again, different market environments, different situations happening at the time. This is one of our decisions that we're going to make, and it's going to be part of our plan. So based on this example, we're going to risk the $300 with the same 15-cent stop, 2,200 shares. If we hit our target, we're going to make $2,200. Right? $300 risk, $2,200 gain, 7.3 R. So at this point here, and the same setup, same 20-cent stop, same entry point, we're going to risk half of our gain, our $600 gain that we have on that 2,000 shares. So we're going to lock in half of that $600 gain, meaning if our stop gets hit, we're going to make $300. Now, the whole focus of this is to maximize our profits, not make small gains. So adding that, we're locking in something, but if everything is working out, right, we're going to be $300 risk, gives us 1,500 shares, times our 60 cents to our target is $900, based on that 3R, based on that trade. Still total risk, 300. Total shares, 3,500. Our total reward would be $3,100. And our total R's, or reward to risk, would be 10.33. $300 risk, $3,100 gain. We still only risked the original $300. Okay, this is what we've covered so far. And now we're going to look at half the position, twice the stop, and then we're going to add to reduce. This is going to be very enlightening, one of the most powerful parts of the course. And this whole course is extremely powerful. Watching it 2 or 3 times, go through the calculations yourself. Of course, paper trade it, get very familiar with it, and then, of course, you're going to do it for real. But let's take a look at this next section. Position and money management, part 7. Half the position to add and average down. Really? We're going to average down at the right time, of course, according to our plan. It says at times we may enter a position that's either in strong momentum that signals move higher, but it's a bit extended. Or we may enter from a lower time frame that's turning up from a bottom, and the higher time frame's in an uptrend, or just bottoming pattern. Or we enter from a climactic buy setup with a wider stop and look to add on the second turn. Many times climactics do a little move back to the downside and then reverse back up again. So there are a lot of combinations here and scenarios, and based on everything that we're covering, you have the information to manage them, of course. Half the position, 2 times the stop, and then add and reduce. So you always have your setup based on your trading plan, based on Master Trader technical strategies. So with all of these initial setups, whatever your risk would be at A, you're going to cut it in half and give it room. And then at B, when that sets up, you're going to go to full position size. Climactic setup, multiple bars moving down, creates the price void. It's extended away from some resistance, ideally in some area of support, some reference point. You've got multiple time frames, what we've been talking about. Or you've got an uptrend, prices are pulling back to a minor support level, double the shares, we covered this, or say half the shares, I should say, and then a move back down, and then we look to add at major support. Higher time frame in an uptrend, and we look to add. And here we've got a W type of a pattern, a retest, and then there's a little shake. These type of climactics and these little extended, even though they're in an uptrend, and these retests, sometimes it could be some uncertainty, could, as we mentioned, related to the market or whatever it might be, and we're deciding to give it a little bit more room to see if it turns. We're going to take the same risk, and if we get a pattern, and in this case we've got a bottoming tail bar, we then look to add at that time and then manage accordingly. We're always including multiple concepts, right? Or support resistance, multiple time frames. What's the trend? What's the trend in multiple time frames? Is there a tradable void? Now, I haven't talked about volume in this section, but primarily volume is a secondary piece of information. It can be useful, but we look for volume spikes. So this could have had a volume spike here, or maybe it happened here. We don't trade volume, we trade price. But volume can be that secondary piece of information. Historically, when volume spikes, and it could have spiked here, of course, but when it spikes, let's pay attention. This could have retested on lower volume, or this may have moved down and then spiked and then reversed back up again. The point is, when we get the type of big volume spike in alignment with the patterns that we're looking for, we want to pay attention to it. What's the broader market doing at the time? So as this was moving down, was the broader market moving down, or was it actually moving up? And this was showing relative weakness at the time. So there's a lot of other information that we have to use to come to a decision for placing a trade. And once we do that, and as we got a position, everything's coming together, we can then apply our money management principles that we've been covering. So here's an example. We've already looked at this, but here we're saying, let's take half of the shares at this time. So we're going to risk half of our $300 risk on $50. We got a 50 cents stop here. So our share size is going to be 300 shares based on that. We've got a potential target gain of $345, and 300 times the 1.15 to target. So we've got 1.15 R. Not a lot, but we're looking to add here. And that's why we would be taking this. Otherwise, we would not be. We'd just be waiting. And over here, if it comes down here, this is where we're going to look to add to our full risk amount. Here's the move down there, and we get our reversal in our area of major support. And here's our entry, 25.35. Our stop is 25.10. We've got a 25-cent stop loss. And we've got still the target of 26.75. And we're going to risk another $150 when we add here, right? Based on the 25-cent stop loss, with a $150 risk, we're going to be able to add 600 shares. And if that makes it to our target area, our gain will be $840. Our $600 times the $1.40 to the target at that point. And that would give us 5.6 R on our $150 risk. So at this point, we're risking our $300, $150 on trade A, $150 on trade B. And here's our two trades that we have working. And we've got a new setup where prices have retraced back up to A. So we've got a deep retracement. As this was moving down, one of the things that we'd be looking for is, which you'd see the majority of times, is that your higher time frame would be an uptrend. This is why I like this kind of a play, where it's pulled back. I'm a bit uncertain, because the higher time frame is still in an uptrend, and this lower high, lower low into major support is one of my setups that I look for. Now here, as it's moved back up, it's proven itself. So as it begins to turn here, I've got a new setup with an entry at 25.90 with a stop at 25.60. And I've got my other two trades working. Now at my add, I have a decision to make. How much do I want to add? At this point, trade A is a break even if it hits my stop. Here's my entry and here's my stop. So I'm a break even there, less commissions, of course. Now at trade 2, I've got a $210 profit. If I add $300 here and my stop is hit, I'll have an $80 loss at that time. But by adding that with that stop, I can add 1,000 shares. And if I make it to target, I'm going to make $850. Right? That's simply my 1,000 shares, 85 cents to target, $850 on this trade, risking 300 to make 850. That's 2.8 R. Now, I could make the decision just to make this trade break even and only risk my $210 gain, not lose the $80. This is about choices. All of these different combinations is about the choices that you want to make. So rather than even risk the $80, I could make this trade a break even by adding the $210, which would get me 700 shares. My 700 shares, not 1,000 shares. My 700 shares would give me a $595 gain, or 1.98 R on my $300. So here is my trade with my $300 additional risk here. There's my trade, 300,000 shares, 850 gain on that, 2.8 R. Now with the combination of my trades A, B, and my add and reduce, I've still only risked $300. I've got 1,900 shares. My target profit would be $2,035, and my R's would be 6.78. In other words, I'd make 6.78 times my $300 risk, or $2,035. So here's our trade setup, and we have yet another choice. And at this point, I think you know what that is. What if we used the $210 gain from B to add to our trade at A and R? Well, here it is. So if I take my $200 gain and my $300 risk, at this point, I'm going to be break even or making some money. I'm going to add that to a $510 risk, which would allow me to add 1,700 shares, $1,445, 85 cents on my 1,700 shares, and my reward to risk or R's would be 4.81, making $1,445 on my $300. Here's the total on this trade with adding our $210 gain. Our max risk was still $300. I was able to get up to 2,600 shares with a target gate of $2,630 with total R's of 8.77. My advanced money management strategy. All right, let's go on to part number 8, our last section. Position and money management, part 8. We've covered a lot of information. You certainly have everything that you need to know on how to manage and maximize your trades. Let's look at a few other things and a few other points that I'd like to cover with you. Statistically, you can keep track of your trades, and these are the calculations that need to be done and kept track of. Of course, we want to know the number of winning trades that we have. We want to know what our average winner is, and it's a simple formula. Just take the dollar gain divided by your total number of winners, and that'll give you that. The number of losers, what your average loser is. And then our main tracking is going to be for a batting average, which is just simply the total number of winning trades divided by the total number of trades. And how accurate are we with the trades that we're picking? And then a simplified Sharpe ratio, which is an average dollar winner divided by an average dollar loser. Very simple. but very telling about how we're doing. Tracking this and seeing how you're doing with, your batting average and your average winner versus your average loser is going to tell you exactly how you are doing and how you're performing and if you're advancing in the right direction or not. And there's software available to do all of this, entering all of your trades into. You can download from your brokerage firm. Some of these software packages have that for select brokerage firms, or a lot of the brokerage firms you can download into an Excel sheet and then into one of those platforms. You can just Google tracking software for trades and it'll certainly come up. So your batting average and Sharpe ratio, these are the two most important statistics that you're going to manage and keep track of. Simplified Sharpe ratio, total number of trades, dollar gained by the total number of trades, and then your total losing trades, dollars, by the number of losing trades, and your batting average, winning trades, by total trades. So what's your batting average? As already mentioned, your total number of trades divided by the total, and here it's a simple calculation, total trades, winners, your losers, and if this is how you were doing, this would be what your batting average would be, or 60%. Now, of course, 60%, you can make a lot of money, but if they're all little tiny wins, you're not going to be making a lot of money, and this is how you need to keep track of your simplified Sharpe ratio. We've already gone over that, and this would be an example of doing that. So you list out your winning trades, your losing trades, and then you take all of those. So you've got 4 winners. That's the total that you've gained, and it gives you $2.75 on average. And then your losers, there they are, 900 divided by 5, $180. So your win-loss or Sharpe ratio is 1.527. 10 steps to becoming a master trader. Maybe there's more than 10, but these are going to give you some guidelines and things that you should be checking against, yourself and how you're doing and questioning. Now, we've talked about trading plans, especially in other sections, but here, without the trading plan, you need to have a plan as to what you're doing. There's no other place like the markets. You can't operate without rules. You can do anything that you want, with your money to trade it in any way. You have to have a plan as to the type of trades you're going to be taking, the time frame that you're going to be trading in, the different setups, maybe even as an intraday trader, the time of day, how you are going to combine various time frames, multiple time frames. You have to plan all of that out, so you have your rules for what you're going to do throughout the trading day. And if you're a swing trader, obviously the type of trades you're going to do, time frames you're going to look at are pretty much cut and dry, weekly and daily time frames. At the end of the month, you'll look at your monthly time frame and see how things are looking from that long-term perspective. And it's just fantastic when you do find setups in the monthly time frames, pullbacks to support with a bottoming tail, and then drilling down into the smaller time frames to get your entry point, that big picture bias, which suggests big move. So you need to develop your money management rules. What I've provided you here gives you exactly that. We've gone over many combinations of how to apply those rules. You have to align those with your personality and your trading style. You have to follow that plan and create a routine and execute it. Bad habits. Well, what kind of bad habits? The biggest one clearly is not taking stops. The other is not taking the trade. For whatever reason, you're not executing the trade. Scared money. You don't feel confident from prior losers. And the answer is pretty simple. Get real small in your trade size and just press the button. But break the habits, work on it one area at a time and improve. Keep records. Keep records of each trade that you take in detail. They're going to tell you a story. When you look at all of the winners and all of the losers, you're going to see a common denominator. I guarantee it. Everybody does. Everyone does. When you look at that, and you see what you're doing right. It's just so simple, of course, to say, just do what's working and don't do what's not working. The psychological part of trading and why it's said it's such a big part of being successful is because you're going to find yourself doing what is, you look at it and think about it, it's insane. Why would you do the same thing that you know statistically doesn't work? Well, because of human nature and just the problem of following the rules in a environment where there are no real punishment for not following the rules, other than losing your money, of course, and the lack of discipline to follow those rules and only take the high quality trades. Now, eventually, by not winning and losing, theoretically, the pain will get bad enough to where you will do that. The frustration and the bad feelings and the losses and such. Hopefully you do that before you run out of money. And that's why it's so important to trade small at the beginning and not focus on the money. Your real focus has to be executing the plan. Now you need to modify that plan. Sometimes you'll see what's working, what's not working, what you're good at and what you're not good at. By checking that, you can adjust the plan. If at any time you're having so much difficulty and getting so frustrated, as I say, just stop trading. Email me. I am available. I have been doing this and helping traders going on 25 years. And I always answer my emails. It may be a day later, but I typically will email you back with comments on your trades with charts. I typically do that when someone emails me and says, hey, I'm doing such and such. A lot of times they'll send me charts. And please, if you do, tell me why you did what you did and the time frames that you were looking at and such. And I will clarify for you what I see and what you're doing right and what you're doing wrong. I'll often get a chart of my own and mark it and send it back to you. The goal here is to make you successful, and there's no reason why you can't. None whatsoever. You are being provided the best education. I have a lot of successful students that have become professional traders, money managers, and if they can do it, anyone can do it, meaning it's just a matter of following the rules, and it's about you executing what you are learning. So create small goals. Make it easy to succeed and have a long-term approach. And it says reward yourself for doing the right thing. All right, so some of you, and probably most of you, are taking the full course, but for those that are just taking the money management part, this is something I covered in the psychology section. And money management and keeping a trading journal is a big part of trader psychology. And this is a fantastic program. It's called Microsoft OneNote. It's probably on your computer. And what you need to do is keep a detailed description of your trade, the market, your thought process, why you took the trade, how you managed it. Was it good? Was it a good trade, a bad trade? Say winning trades, losing trades. Trades that you wanted to take, you didn't pull the trigger for whatever reason it is. And you set it up like this: winners, losers, passes, anything you want. And you can keep track of that, and it's a great program. You have it says screen clipping, but you can capture your charts and it puts it in there, and you can mark them up. You can record your thoughts in there, and videos. It's a great program. In addition to that, I printed out charts for many, many, many years, and I definitely think you should do that as well. Printing out charts, and you don't have to do every trade, especially if you're an active trader, but capturing them and putting them in this program takes a minute or less. You mark them up, and you do have to put some thoughts, but you can talk and come back and review what you said. But what I did for years was just printing out charts and marking them up and writing my thoughts and what I did and marking support and resistance or bottoming tails. And eventually, as I learned the shakeout patterns and such. And I'd have a big stack of paper sitting next to my bed. And at night, after scanning and looking at charts, I'd pull out that folder of charts, or even on a weekend, and I would go through them again and study what I wrote and see if I missed things when I wrote things down. Over time, you learn more. And going through this process, even with paper as well as this Microsoft OneNote, it's an exercise that is so valuable in putting everything together and keeping the numbers and writing them and the charts. You do this and you'll succeed, and you're looking at what's working and what's not working, and you'll stop with the what's not working, and it'll all come together. Here's an example of one that I've marked up that shows the setups and the entry points, the daily chart and the intraday chart, and then what the market was doing at that time, and stop, entry targets, share size, risk, some patterns as to why, what was going on at the time, was there market alignment, where it sold. Got a little nervous, I didn't want to give back money, didn't follow the plan at that time, could have made more. And add and reduce on the pullback to the 20 MA, sold on the wide range bar, entering midday. I just wanted to go to lunch, right? Overall, was a job well done, profitable trade. Click on the losers and, put that in there with the same comments and guidelines as to what you did wrong. Or maybe you didn't do anything wrong. I mean, it could have just been some type of a whipsaw, whatever it might be. Give it a objective overview of what happened. Becoming a master trader. Right? Choose the type of trading and investing that's right for you. I've worked with many that thought they wanted to be intraday traders, and maybe they wind up being, but what most do is that because they think about small losses, they trade from very small time frames. They may have eventually a decent batting average, but their wins are so small that they really don't make any money after commissions. I've worked with others that have made very good money, and they're active and they get so good at what they're doing on smaller time frames that average out of trades and look to add where they can, and they maximize their gains. Call them nervous, whatever it is, but they have been able to get really good at that. Whether that's for you or not, part of the process is figuring that out. And trade small. Press the button all you want and find out if that's for you or not. Maybe you find out that trading from 15-minute charts or hourly charts. I've worked with quite a number, hourly charts and daily charts, and holding on for a couple of days. There's so many different ways of making money, and you just have to be comfortable with what you're doing and get really good at it. What strategies are you going to become an expert at? Always questioning, are those strategies and tactics lost their effectiveness? Meaning market environments change. Certain tactics or strategies that were working well, they stop. The market could be trending, and buying pullbacks to minor support have been fantastic, and then the markets start going sideways, and every pullback at minor support jiggles around, and then it fails and goes down to major support. But you do have money management strategies that we've covered to do that if you see that's what's happening. Or if things are trading sideways and breakouts are failing, go to a higher time frame, condense the data, remove the noise by compressing data in higher time frames. And you can trade from that higher time frame, and the other choice is to just stand aside, which is fine to do, and just wait for things to clean up. And you won't be psychologically beaten up by fighting with the market, which no one can win. So you need to be able to identify your plan, your strengths, and your weaknesses. Emotions, very important to control. And the first step to controlling them is to monitor yourself. Are you feeling down, or are you feeling, hey, things are great? And whatever it is, you just need to monitor your thought process, and you learn to control things. And you can never be a robot, because we're human, and that you're not going to be a Mr. Spock. That's just not going to be possible. So the thing is just being aware of your thought process and what's happening. Consistency is the key to success. And trading small size to where the money doesn't matter is a major key to doing this successfully. Starting small, having a long-term approach, and look, the setups that you learn, they're not hard. They're not hard to determine the trend, as I explained it. Is it going up, down, or sideways in multiple time frames? Are they lined up or not? Is there a tradable void? Is the pattern showing certainty or uncertainty? You'll find that just by scanning and looking for the setups. Just becoming familiar with them takes some time, and becoming an expert at them, and you need to give yourself that time to do it. And then things start to become second nature by doing that. It's like anything else with experience. I don't care what you did, whether you were, a doctor or a lawyer, or, whether you operated a crane at a construction site. Someone taught you how to do it, and then you had to get in there, and it probably was a little scary, whatever it might be. And then eventually it becomes second nature. And this is the same thing. Reward yourself for small victories. Feel good. Don't be hard on yourself. Keeping things in perspective, small amounts can add up. $200 a day, 50 grand a year, right? And you say, well, making $200 a day right now is difficult for you. Understandable. You're just trying to maybe break even, but you're gaining the tools and to do this and to do it successfully. So you can do it. 500 a day, 125,000 a year. And it's all about share sizing and getting good at the strategies that you're learning and the money management and the position management and putting it all together. If you're not making money after a period of time and doing all the things I'm talking about, are you trading with scared money? And a lot of people do. They want to get into the markets and learn, and they push themselves too hard with, putting on too big of positions. Prop trading has become very popular, maybe a little bit less so of late, but I think that many that were undercapitalized that got into that is just, or gas on a fire, adding margin to an undercapitalized trader, trading more with scared money. It doesn't work. Going to a prop firm to margin money where you have money and you just want to leverage it, you can do that. And I've explained this to others in that, if you just want to trade stocks, I get it, because you just want to be a stock trader. But you do have to take a test. You have to tie up your money for a year to do that. You have to become licensed. Whereas you can trade futures, you can trade equity E-minis, you can trade currency E-minis. There's Forex, of course. Basically, if you can read a chart, you can trade anything. It's all about the liquidity, and is it trending? Is it the clean patterns? That's the focus. It doesn't matter what you trade. I traded stocks at the beginning. That's all I could trade. It was available. And then after the bear market of 2000 into 2002 and beginning into 2002, things were beaten down so bad, stocks became very difficult to trade. And I traded futures. And then I did that for quite a number of years. And then when volatility contracted, I went back to trading stocks. And now, volatility is a bit more, and the futures are moving, but there's always currency futures. So there's lots of different options. Now, I'm not a big proponent of going the prop trading route just because of the tests years ago. Because I did own a brokerage firm, I needed to take those tests to do it. And they're not easy. It takes a lot of studying to pass them, and just the time required to do that. It was like, why bother if there are other options out there to trade? A lot of people are afraid of futures, but there's really no need to be, because it's all about discipline, and you're, using a platform that puts in your stops automatically and such. Money management, what you're learning right here. How much time can you devote to trading? Day trader is easy. Do you want to be a swing trader is easy in core trades. Day trading, you have to decide, you just trade in the mornings, which a lot of people do. And then move on, or you want to be there all day. There's choices. You have to follow your plan, patience and discipline. Without that plan, patience and discipline, you don't have a chance. So I just wanted to look at a couple of charts. This chapter is not about the chart reading. Right? We talked about management through bar by bar and pivots, but once you learn the patterns, it's just about finding them and then management. And here we have an instrument that was trending at the time, and we see red bars being ignored and retests. Here's just a simple breakout type of a pattern here, and you're putting your stop down below here and then managing. And once it pivots and it moves up, just like I explained, you could bring your stop up, and then you're going to get stopped out at times just here. But this would have been a nice gain, and then was a whipsaw and back up, and you're just reading the pattern again. With the volume, big wide range bar to the downside. It said it was going lower, and it came right back up again. It is in an uptrend. The 20 and the 50 are rising, which tells me that the weekly's in an uptrend too. So it had a whipsaw, and it came right back. It's going to go higher. Reading the patterns, retest, triple retest, and there's a pullback here into minor support, and this could have been a profitable trade as well. And while we're looking at a daily chart, this could be a 5-minute chart, and you can say the hourly chart's in an uptrend, and you're buying the pullbacks and breakouts on the 5-minute. It works. It's all about recognizing the patterns and pullbacks to minor support or major support, and bottoming tail bars and retests and volume and relative strength and weakness, everything that I've explained during the course. And this example is one that it's messy. And while we could trade this, we could find patterns to trade. When I see something like this, it's like I think to myself, why bother with it? I can go find better out there. I don't have to trade a particular stock or a particular instrument if it's not setting up the way I know how to do it. So I just don't. I want it to be relatively easy. And there will be times where things may set up and it doesn't work out. It's just part of trading. Some sloppy stuff going on here. I mean, I like this gap down and reversal, but you see it's up at the resistance here. You have to wait for it to set up. And in the candlestick section, we went over what to look at, whether I spoke about shakeouts. I'm going to look at a lot more of that in the last section of the class, the different patterns and charts and multiple time frames. I'm going to put everything together that we talked about in there, and we're going to review it. So this slide here is just for your use to see the calculations. I showed you the calculations at the beginning of this module, where it was based on an account size and $300 risk, and we used that $300 risk for all of the examples. So here is just showing you $10 risk. Here's the stop. Here's your share size, $25 stop, share size, so on and so forth. And you can use this as a guide just for yourselves when you say whatever you're going to risk. And a lot of software packages, you can program this in there where you have different selections as to whatever your risk is and your stop, and you can pre-select those and put in targets and such. But this gives you a guide very easily to say, well, whatever I'm risking here, I know that I need to adjust my share size to whatever it is that you're going to decide to do. And here is another one. So $100, $150, $200, $250. We did the 3. The calculation is very simple, so which I already showed you. But here's some guides as to exactly what it is for these different risk levels. Attributes of successful traders, and you can probably come up with more, but here are some things to consider. Objectivity, and they're disciplined. That's that big word, discipline. They have a sincere desire to succeed and a single focus. You say, well, doesn't everybody have a sincere desire to succeed? Maybe, maybe not. How hard are you willing to work at it? Truly enjoy what they do. You have to love this, because it's not easy. It's not easy because of the psychological part, and I have to say it is what it is, but you have to love to do it. Keep a positive attitude. They don't have self-limiting beliefs. You have to believe you can do this and you can do anything and you're unstoppable. Have a plan outlined, step-by-step routine and goals. Visualize your goals and rehearse them daily. Rehearse seeing that setup in your mind, grabbing the mouse. I had a fella tell me this many, many, many years ago that was a professional trader when I was beginning my learning process. And I forget where I met this fella, but I thought to myself when he said that he said he would rehearse picking up the mouse and pressing the button. And this was a long time ago. And it stuck with me. You're accountable for your actions. Don't make any excuses, right? Consequences and repercussions when they break their plan. They have realistic expectations given their experience, and they never give up. Never. Want it bad enough? Well, do it. What can you control? You can control a lot, right? Your routine, your scanning, your stock entry, your stops, your targets, what you do with it after entry, how you manage it. That's what we've been covering here. How you control, how many trades you take, when you stop trading, how hard you're willing to work. You have to be willing to work hard. When I first started doing this, before I was doing it professionally, I had another business, and I would go to work there 7 o'clock in the morning. I would be there, probably up at 6, come home at the beginning when I started that, 12, 1 o'clock in the morning, eat something, download the data, which would take a long time. There was no internet, and start studying the charts and writing my notes. And when I got too tired to keep my eyes open, when I went to go to sleep, I would read a book about trading for a while until I passed out and do it again. That's what it takes. You have to want something badly. That's what that single focus is about. Don't stress over what you can't control. You can't control the market. You can control yourself. That's what this is saying. You can control yourself. You can control when you press the button and what you take trades on and how you prepare for the trading day. Say position and money management. We covered a lot of information here. I covered basic management with you and what you might be doing now. I covered a lot of advanced stuff and how to utilize that. There were a lot of calculations there, but you look at that a few times, you'll see it's pretty simple. You just put it all together. And other sections of this seminar and put that all together and providing you the tools to truly be a master trader. And this position and money management is a huge part of doing that. As mentioned, you can know all the technicals like the back of your hand, but you need to get this down, the position and money management part, and you can apply it to anything. I don't care what you're trading, stocks, futures, currencies, it makes no difference. You have the management and your share sizing, you'll calculate that accordingly and manage it, and your adds and your reduces and half profits, and you'll figure that all out how you want to put that all together, and you will be that master trader. And as I mentioned, any time you run into things more difficult and getting frustrated, email me, contact me, and we're going to have some sessions together after the class to review stuff. We're here for you and to ensure, as long as you're willing to work hard, that you will be a profitable master trader. Good luck.